Welcome to Talk Tickers, the deep dive into the financial stories you need to understand right now. Today, we're pulling back the curtain on one of the most consequential rules in American finance. I'm talking about the gatekeeping structure that really decides who is legally allowed to get rich faster.
That's absolutely the core of it. We're dissecting the legal definitions that control access to the most dynamic, high-growth financial opportunities out there.
Private markets.
Exactly. This is where explosive wealth is often created before a company ever even thinks about hitting the public stock exchange.
So our mission today is to unpack the specific requirements for what's called an accredited investor. And then there's the even more exclusive qualified purchaser designation.
Right. We need to look at the financial thresholds, the newer professional criteria, and crucially, why these rules, which, were first designed for investor protection, are now so central to the wealth divide we see today.
They really define who gets a seat at the table.
Or who's left outside. They determine who gets to put money into venture capital, private equity, hedge funds, the real engines of modern portfolio growth.
Okay, so let's unpack this then. When we talk about an accredited investor, an AI, what are we really defining?
Simply put, an AI is just an individual or an entity that's allowed to invest in unregistered securities.
Unregistered. So not the stocks you buy on your brokerage app.
Not at all. Because these investments are private, the companies selling them are exempt from all the costly, really stringent disclosure rules that public companies have to follow.
And that rule has been around for a long time.
Since the 1930s. And the assumption was always pretty straightforward. If you had enough money, you were, one, financially sophisticated enough, and two, more importantly, you could withstand a total loss.
You could lose it all and not end up on the street.
That's the idea. So the gates are built primarily around wealth.
So what are those classic financial gates for an individual?
There are two main paths. The first is the income test. An individual has to have earned income over $200,000 for each of the last 2 years.
Okay.
Or if you're married or have a spousal equivalent, that joint income has to be over $300,000 for those 2 years. And, you need a reasonable expectation you'll hit that mark again this year.
200,000 is already a pretty high bar for most people. Mm-hmm. But the other path is based on net worth, and that one has some really critical asterisks.
It does. The second path is the net worth test. An individual or a couple must have a net worth of over $1 million at the time they invest.
And here's where it gets really interesting, because there was a big policy change. When you're adding up that $1 million net worth, you have to exclude the value of your primary residence.
Yes, that exclusion was a huge change put in place back in 2011. It was basically a reaction to the housing bubble.
Because home equity was making people look richer on paper than they actually were.
Exactly. The idea was to make sure an investor had substantial liquid or investment wealth, not just, paper wealth tied up in the house they live in.
That makes a lot of sense. But it gets even more complex because while your home's value is excluded as an asset, any debt on it still counts against you.
That's the real kicker. So if you have an underwater mortgage or maybe a big balance on a home equity line of credit at HELOC, those liabilities have to be subtracted in your net worth calculation.
And that could be the very thing that pushes you below the $1 million line.
Absolutely. Even if you have millions in other assets, let's make this tangible. Imagine 3 people, Alan, Brian, and Carla. They all have the same non-home assets, let's say $1,225,000.
Okay.
And they all have $200,000 in other debt, like student loans. Now, Alan has a small $50,000 mortgage. His final net worth is just over $1 million. He qualifies.
He's in. What about Brian?
Brian has the same assets, but he took out a $100,000 HELOC. That extra debt, because it's tied to his home, has to be counted. It pushes his net worth just below the $1 million threshold.
So he fails the test.
He fails. And Carla, in our example, has an underwater mortgage. That debt significantly drags down her net worth. She also fails. So you see, it's not just about how much money you have.
It's about how your wealth is structured, especially the debt on your biggest asset, your home.
Precisely.
That's a powerful point. But, the definition of sophistication has started to evolve. For decades, wealth was the only gatekeeper. But recently, the SEC started asking, is money the only measure of financial smarts?
And that's what's so fascinating. In August 2020, the SEC finally amended the definition. They created a new pathway for investors to qualify based on professional knowledge, experience, or certifications.
A non-money path.
A non-money path. In addition to the old financial tests, it was a critical shift.
So who qualifies under these new professional rules?
Well, first, individuals who hold certain professional credentials. The SEC started with a few key licenses from the financial industry.
Like the Series 7.
The Series 7, which is for general securities, the Series 65 for investment advisors, and the Series 82 for people in private securities offerings.
That feels huge for people who actually work in finance, the analysts and compliance folks who get how risk works but haven't hit those 7-figure milestones yet?
It is, though you could argue a test alone is a bit arbitrary. But still, it's progress. They also included knowledgeable employees of a private fund, but only for investing in their own fund, which just makes sense.
Right. If you work there, you should know what's going on.
And then, of course, directors, executive officers, general partners of the company selling the securities. That's another nod to insider knowledge.
And this expansion wasn't just for people, right? It was for institutions, too.
Yes. The SEC broadened the definition for entities. So now, limited liability companies, LLCs, can qualify if they have $5 million in assets. Registered investment advisors, both SEC and state level, also qualify automatically.
So if you meet one of these criteria, income, net worth, or a license, are you just good to go? Is there an application you fill out?
No, absolutely not. And that's a key point. There is no formal government certification. The legal burden is 100% on the investment issuer.
The VC fund or the hedge fund.
Exactly. They have to verify your eligibility. And since 2013, just having an investor check a box saying, I qualify, isn't good enough anymore.
So what do they actually do to verify? What do they ask for?
They need documentation. It usually starts with a detailed questionnaire, but then they'll ask for hard evidence. They'll want to see your W-2s to verify income or bank and brokerage statements for assets.
And a credit report, I'd imagine.
A recent credit report to check your debts and actually calculate that net worth. If you're using a license to qualify, they'll check the regulatory database like FINE and R to make sure it's active. It's a pretty invasive process, really.
Okay, so that's the gate to the Accredited Investor Club. But you mentioned earlier that there's an even more exclusive level, the qualified purchaser.
That's right. If being an accredited investor gets you into the VIP section, being a qualified purchaser, or QP, is like getting into the secret back room.
A whole different ballgame.
It is. This is governed by the Investment Company Act of 1940, and it sets a much, much higher bar based purely on the size of your investments, not just your overall assets.
What's the threshold for that?
A QP has to own at least $5 million in investments. And the definition of investments here is pretty narrow. It usually excludes your primary residence and other real estate.
$5 million in stocks, bonds, things like that.
Pretty much. Or, for an entity, they have to be investing at least $25 million on a discretionary basis for other qualified purchasers.
So it's clear that all qualified purchasers are also accredited investors, since $5 million in investments is way higher than $1 million in net worth.
Precisely. And these different tiers give you access to different kinds of funds. QPs can get into what are called 3C7 funds, which can have up to 2,000 participants. AIs are generally limited to 3C1 funds, which are capped at 100 or 250 investors.
So there are levels even within the exclusive world of private markets.
It's all layered.
Now, this sounds like a pretty solid wall keeping everyday investors out, but we're starting to see some cracks in that wall, right? These new hybrid vehicles coming out.
This is where things like interval funds come in, and it's a huge trend to watch. They are a hybrid. They mix features of a regular mutual fund with a private equity fund.
And the key is that they're registered with the SEC.
That's the key. Because they're registered and regulated, they can offer strategies like private credit and private equity to a much wider, non-accredited public.
But how do they do that? How do they hold those illiquid assets if a mutual fund has to offer daily liquidity?
That's the clever part. The liquidity is limited. An interval fund doesn't allow daily redemptions. Instead, they only offer to buy back a certain percentage of shares at set intervals, usually quarterly.
So you know going in that you can only get your money out, say, 4 times a year.
Exactly. And that predetermined limited liquidity structure is what lets the managers invest in those less liquid private assets. It opens up what's called the illiquidity premium to a much wider audience.
That's the potential for higher returns you get for being willing to lock up your money.
Right. And they offer lower minimums, built-in diversification, and a much simpler structure. It's a big deal.
Okay, let's pivot to the core debate here. The impact these rules have on risk, returns, and, economic inequality. Being an accredited investor gives you a clear, measurable financial advantage.
No question. It's access. Access to opportunities that can accelerate wealth creation. Talking about VC, private equity, hedge funds. They can offer truly exceptional returns that often have no correlation to the public stock market.
Which is great for diversification. But the non-accredited investor is supposedly being protected from some serious drawbacks. What are they?
Well, there are three big ones: risk, cost, and commitment. First, the risk is real. These are often aggressive strategies trying to beat the market, and they can fail spectacularly.
And the costs?
The costs are staggering. High minimums to even get in, and then you have high management fees plus performance fees, which can take, 15 to 20% of any profits you make.
And then there's the commitment, the illiquidity you mentioned. Your capital is just locked up.
For years, 5, 7, maybe 10 years. You can't just sell when you feel like it.
Which brings us to the really big systemic concern. This isn't just theoretical. The data shows that the financial advantage for the wealthy is a serious accelerant to inequality.
It is. Financial assets held outside of retirement accounts, so the assets held mostly by the wealthy, they consistently earn a higher average annual rate of return.
I've seen that data. It shows something like 9.34% annually for those exclusive assets.
Compared to about 7.45% for a typical retirement account, like a 401k.
Now, that might sound like a small gap, 1.89 percentage points? But that difference, when it compounds over decades.
It's massive. The wealthy aren't just earning returns on a much larger pool of money. They are earning that money at a faster rate. It accelerates the wealth divide through pure mathematics.
And this gets to a really serious regulatory paradox in our financial system. Your retirement savings, the main way ordinary people invest, are governed by a law called ERISA. And that law is obsessed with risk reduction and prudence.
And that focus on protection is a good thing. It's designed to stop catastrophic losses for savers. But the unintended consequence is that it funnels most people into safer and often lower return funds. The goal is safety over opportunity.
Meanwhile, you have exclusive practices like short selling, which are mostly available only to the wealthy. And they often rely on borrowing shares from those very same retirement accounts.
Right. And the regulations around those strategies are all about maximizing market efficiency and opportunity, not safety.
So you have this split.
A fundamental split. On one side, intense protection for the ordinary investor. On the other, aggressive expansion of opportunity for the wealthy investor.
Oh.
And that just adds more fuel to the fire of the wealth divide.
So what does all this mean for you, the listener? The accredited investor rule, it started with a good intention, right? Shielding the vulnerable from catastrophic loss after the Great Depression. But when you look at the whole ecosystem today,
where the greatest wealth is created in private markets before the public never gets a chance.
the rule effectively blocks economic mobility based on your capital, not your capability or your knowledge.
And when the rules allow this unequal access to constantly fuel faster wealth creation at the very top, it just entrenches inequality. It creates a system where knowing what to do isn't enough. You have to already be rich to get in the door.
So here is something to think about. The very system designed to ensure your financial security, your retirement account, is also a crucial source of the shares needed to fuel these exclusive, high-return strategies, like short selling, for the already wealthy. Should policymakers keep assuming that what's good for the capital markets is always good for the broader economy? Or should wealth inequality become an explicit fundamental factor when we decide just how much of these exclusive financial practices we should permit?